Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of Kansas City and Minneapolis wheat markets. I'll start with Kansas City wheat. The low water mark of the 18th of August was pivotal to the construction of what happened next. Back then, the market failed to break down through the neckline, currently 825, and highlighted in bright red on my daily chart, with a small but influential October 2021 to January 2022 head and shoulders top. Now please bear this neckline in mind as it will crop up again later on. Anyway, the market chose back then to construct a new pattern, a bull channel. The market moved and penetrated the 957 area, the gateway to a congestion area above, between 957 and 1001. Prices rose within this area, pushing up over the long moving average, currently 993. Additionally, a lot of this congestion was old and had been made up from 2011 and 2012, and was thus easily breached on the way up in February and on the way down in June. But back in those days, the congestion did not have the additional reinforcement of the long moving average in its midst, and it is this reinforcement, along with the upper bull channel line, that constrained the rise in early October. In the process, prices took on a new shape, primarily caused by the weekly key reversal down made that same week. In fact, it is hard to judge if the shape made the weekly key reversal down or vice versa. Anyway, at the end of that week in October, the market broke down through the lower bull channel line, also dropping out of the overhead resistance area, and started moving below the now flattening medium moving average for a while, currently at 913. Then, along came the very early November action, or as I refer to it, a week of time wasting, but also a week of defining industry. This is a parallel of what we saw in Chicago wheat futures. Now I will expand on that shortly. But first, much like Chicago wheat, though it is not a complete duplicate, this market here had two avenues. In this case, as in Chicago wheat, the market chose the first avenue. To describe this route, I'll refer to my commentary from a few weeks ago, and I quote, "The first is the straightforward move down with potential targets for the break of that bull channel. Thus we have a primary target X down in the 903 zone, whilst a secondary harder to reach target X1 is way down below in the 759 zone." End of quote. 4 weeks ago, the bearish pressuring of the market finally started to show results with a significant move below the medium moving average and reached the primary target at 903. 3 weeks ago, it continued lower, all the way down through the 50% Fibonacci line of the August 2020 to May 2021 move at 900, and the 50% Fibonacci line of the September 2019 to May 2022 move at 881, as well as the 2013 high at 862. 2 weeks ago, early on, much the same happened, down through the 2014 high at 855, but then by midweek, the market hit the bright red trend line on my daily chart of the neckline of the small but influential October 2021 to January 22 head and shoulders top. This is the one I asked you earlier to bear in mind, and things stopped. Prices even rose up through the congestion between 855 to 881, including the 2013 and 2014 high, as well as the 50% Fibonacci line at 881. But the rise was tempered by these resistances, eroded, probably a better word, and the market back down to the red trend line, well, down to the red trend line below, early this week. Yet this neckline held again, and we've since seen prices rise again into the overhead resistance area between 855 to 881, but not as far as the 50% Fibonacci line, not yet at least. It's very much as I said back 3 weeks ago, and I quote, "It will all depend, should prices choose to move lower, what they will do at the red neckline. Remember, the market is held up by this simple looking support back in August." End of quote. We were then being held up by this neckline, and so we are again today. The only difference is that we now have a congestion area overhead which can act as a cap on any rises if it chooses to continue to do so. Now, if it does, then the market will be slowly becoming trapped between the slowly rising neckline and the congestion overhead. And at some point, something will have to give. Two things to bear in mind. Firstly, it'll be interesting to see if target X1 in the 759 zone will be temptation enough for a move lower. Secondly, we have a possible dead cross in the offing of the declining short medium moving average almost crossing what looks like a flatlining medium moving average. Now this needs further study, but please bear in mind this is a lagging indicator. Minneapolis wheat. In early September there was the start of a new bullish pattern. It seems to have been prompted by the approach at a steep angle from above of the short medium moving average, currently 948. And rather than this moving average acting as a cap on any rise, it instead acted as a trigger for a move higher. This rise seems to have been slowing here. Well, this seems to be slower here overall than in the other grains, which is a nice segue into the bull channel come ascending expanding wedge pattern formed until early October, and the one I've highlighted in dark blue on my daily chart. I previously called this construction rudimentary, not only because it was back then rudimentary, but also because the market is, as I've often said before, this market was way behind both Chicago and Kansas City wheat in its construction of such patterns. You only need to look back at the long moving average, currently at 1025, and the medium moving average, currently 940, to see this. Incidentally, this medium moving average looks to have triggered the limited move lower seen in early October. Just look at the relative positions of these moving averages compared to the same moving averages in other grain markets. And that's to appreciate how shall I put it, how inferior the actions here have been compared to the other grain markets. Anyway, as I said in early October, the market broke down through the lower trend line of the bull channel, come ascending, expanding wedge pattern. This left us with the same two avenues here we saw both in Chicago and Kansas City. The market chose the first avenue, the straightforward move down with potential targets for the break below the bull channel, come ascending, expanding wedge pattern. Thus, we have a primary target X on the downside, quite a way lower compared to the other grain markets, and that's in the 883 zone, whilst the secondary harder to reach target X1 is down in the 840 zone. 2 weeks ago, the market made a strong attempt to get down there, and it looked like the market was really going to go for target X at 883. But it soon ran out of steam. This now places a question mark over the whole decline and whether there is enough ammunition to take prices down to 883. Additionally, and it is way early on this point, but it seems best to discuss it now, but is there the possibility for the whole of July to date action, possibly even the action from June to date, to be a very large double bottom? It will very much depend, I suspect, on whether the market will drop down to target X and what it will do there. Alternatively, it also depends on whether the market rises up to the medium moving average overhead, and again, what it does there. Thank you for listening. This weekly broadcast gives you essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright is Tofpik and ADM Investor Services International Limited. And here comes the final bit.